Hey everybody, welcome back to Actual Investing. Today, UiPath, ticker PATH, is taking a massive haircut down 31% after hours after reporting their first quarter fiscal 2025 earnings. So what happened? A lot of bad shit happened. Their CEO stepped down. Their ex-CEO, who just stepped down at the beginning of this year, not even 5 months ago, is stepping back up. They had an unprofitable quarter. Their growth is slowing, and they reduced their full year guidance. Yikes. I can see why the stock is down so much. But is it down too much? Is this an overreaction? UiPath is now trading close to its all-time lows. So let's take a look deeply into this earnings report and find out if the market is overreacting and if this might be a buying opportunity for people looking to invest in Path stock. So what does UiPath do? Well, their website demonstrates with these cute little software robots, but essentially what UiPath is a robotic process automation company. Now this has nothing to do with the cyborg type robots that you might think of. It really has little to do with robotics in general. Essentially this is software that helps automate repetitive tasks for employees. For example, let's say you work in a bank and you want to automate the boring form verification process when you get a new client or when somebody applies for a loan. UiPath can be programmed to learn repetitive tasks and handle them so that you don't have to pay an actual employee to do the process themselves. So this is a type of company that saves people money. This saves other companies money. So intuitively, you would think that UiPath would be doing very, very well. Additionally, UiPath is somewhat of an AI stock, so you would think with all these advances going on in AI that they would stand to benefit. However, they have not been growing as quickly as one would expect. They had a slight acceleration in growth a couple quarters ago where they hit 20% plus year-over-year revenue growth, but that's slowly going back down, which we'll talk about in a little bit. All right, so now that we know a bit about what UiPath does, let's talk about the earnings release. So the first big thing is that their current CEO, Rob Enslin, is stepping down as the CEO and as the board member. So typically when a CEO steps down, they'll remain on the board if things are amicable. However, this individual, Rob Enslin, is leaving the board and the CEO. However, I still have reason to believe that this is an amicable breakup, if you want to call it a breakup, because it says Enslin will stay engaged with UiPath as an advisor during the transition. Okay, so he's not being ousted. He's not leaving in a fit of rage. He is sticking around, but he's not going to stay on the board anymore. And Daniel Dines, who is the founder of UiPath and former CEO, will be reappointed, which is funny because at the beginning of the year, according to SiliconANGLE here, UiPath co-founder Daniel Dines stepped down. So what is going on here? Mr. Dan Dines stepped down on January 31st, 2024, and now he's stepping back up. To me, this is the type of uncertainty that the market really does not like to see. We don't like to see management changes, especially not a CEO change, the most important person in the business. So to have this happen twice in the same year, involving the same person is now coming back, the person who already stepped down and left, is he going to stick around this time? I think there's a lot of uncertainty right now. And now, this might be overlooked if the company was smashing their targets and performing exceptionally well, but they're not. They're performing not so well. Let's look at the release. So this is their first quarter fiscal 2025 earnings report. They had revenue of $335 million this quarter. Last quarter, they expected revenue in the range of $330 to $335 million. So they hit the top end of their guidance. Great. I love that they were able to predict what they were going to make and that they actually hit that on the high end. That's awesome to see. However, this was growth of 16% year over year, which is down from the 19% year over year growth they had in the quarter before and the 20+% year over year revenue growth that they had the quarter before that. Now, it's natural for revenue growth to slow over time. As companies capture more and more market share, they're not going to be able to grow as quickly. However, this is a rapid deceleration of revenue growth after a rapid acceleration of revenue growth. So things are kind of whipsawing back and forth at UiPath. They had a really, really great quarter and then two kind of meh quarters. All right, so we acknowledge the revenue and the growth. Now let's look at the guidance for the full year, because with any growth stock, guidance is the most important thing. It doesn't really matter so much that they hit their targets. What matters is what they're expecting going forward, because growth stocks and the market in general are always forward-looking. So for the full fiscal year 2025, UiPath is updating its guidance. Sometimes that's good. In this case, it's not so good. They're expecting revenue of $1.41 billion. Here's their last release where they expected revenue of $1.56 billion. So that's a 9% cut to their fiscal 2025 revenue guidance. That's a pretty big cut, especially since it's only been 3 months. Did so much really change in those 3 months? So we have a CEO stepping down, the old founder and old CEO stepping back up, and a 9% guidance cut. Yeesh. There's a lot going on here at UiPath. I'm not really sure what to make of this. So why this guidance cut? Well, we get a bit of a clue here from the CFO Ashim Gupta. During the first quarter, we saw increased deal scrutiny and lengthening sales cycles. Lengthening sales cycles seems to be the excuse that most SaaS companies use when they're not meeting sales targets. I'd just like to point that out here. Not sure whether it's a real thing or not, but I've seen this so many times. Anytime there's a revenue miss or a guidance cut, it's always because of lengthening sales cycles. Why aren't people closing these deals? Is it because the platform isn't as beneficial as we're led to believe? Maybe. But anyway, lengthening sales cycles for large multi-year deals. We have considered these factors, the current macroeconomic environment, and our leadership transition, and our updated guidance for the remainder of the year. While our revenue and operating margin guidance is impacted by contract timing and duration, we have confidence in our ability to generate durable ARR, which is annual run rate or annual recurring revenue, growth at scale, and meaningful non-GAAP adjusted free cash flow. Okay, so this seems to be a bit of a cop-out answer, but it sounds like there is going to be some uncertainty due to the leadership transition, and these lengthening sales cycles, again, make me think that perhaps UiPath's platform is not as beneficial to companies as I would have originally thought. You would think that in tough macroeconomic times, people would be adopting a software that helps save money, but the fact that they're not adopting it very quickly shows me that maybe it's not as useful as we're led to believe. All right, now let's head over to my spreadsheet. This is my spreadsheet where I track growth stocks and I rate them on 4 factors: gross margins, annualized revenues, price to annualized sales, which is a valuation metric, and year-over-year revenue growth. So out of each of these 4 factors, you can get a score of -1 to 5 for a total max score of 20. My average is about 12. So even with these new numbers that just came out, UiPath scores a bit above average. Their quarterly revenue growth is down, it's slowing, however, it's still double digits. 16% revenue growth is quite respectable. Their valuation is pretty reasonable, especially considering they have very healthy gross margins of 86%. So their valuation before the drop was 7.8. But as we know, the stock is down about 30% after hours. So if I go in and change this market cap from 10.4 to, let's say, 7.4 billion, we see that their valuation is closer to 5.5, which is under average, especially for a software company. Typically, software companies sport a higher price to annualized sales. The one thing to pay attention to now is their profitability. So they are spending a lot on their SG&A, which is selling, general, and administrative. So this is things like hiring expensive developers and advertising and expensive staff. They also are spending on R&D. So we see that these two numbers add up to over 100%. So as a general rule, UiPath is not net income positive. They're not profitable on a net income level. However, they did have a profitable quarter last quarter, and they're back to negative net income this quarter. So my question is, when are they going to have sustainable profitability? I don't think they can keep flipping back and forth between profits and losses. I think that's going to make investors get very impatient and upset and leave, especially amidst a CEO transition and lowered guidance. To me, I can understand why UiPath is down 30% today. Now, is that an overreaction? That's a great question, because anytime there's bad news, we need to look and see if the bad news was really that bad. I think it's safe to say that yes, this was bad news. However, does it merit a 30% drop on top of a stock that already has not performed terribly well? I don't think so. I think this may actually present a buying opportunity. Here I was being bearish on UiPath the whole video. I bet you thought I was going to say it was warranted. But I like to be objective, and even though UiPath's numbers are pretty disappointing, I think we need to take this with a grain of salt and look at the market and say, I think you're discounting UiPath a bit too much. I'd like to hear the earnings conference call and see if there's any reason as to the CEO stepping down. Maybe he won't say, maybe it's personal, but it would be nice to know if there was a reason. And if it was a bad reason, I don't think the company's going to tell us. So I think we're just going to have to be left to speculate on why the CEO is stepping down and why the old CEO is suddenly fine to come right back to where he was, where he just stepped down from not long ago. But at the end of the day, the company is still growing, and they do have strong gross margins, which ideally they can turn into profits. However, it hasn't been a smooth sailing road so far. So I think if you are an investor who doesn't mind a little bit of risk, UiPath represents a high risk, potentially high reward play. For me, I'm going to look to potentially open a position in UiPath tomorrow if it stays down like this, because even though these numbers were quite disappointing, I think UiPath still has a bright future, and I think that a software that saves companies time and money is going to be hugely beneficial, especially as staff become more and more expensive. Besides, who wants to do all those repetitive tasks anyway, right? So let me know what you think below. Is UiPath a buy for you? And if there's any stock that you want me to cover, please also leave that down in the comments below. Thank you so much for watching. Please, if you liked this video and you want to see more content like this, hit the like button. That really does help. And please subscribe to the channel if you're new. I would love to have you around. And if you didn't like the video, dislike it. Tell me how I can improve. I welcome criticism. So anyway, thanks guys. Good luck if you're an investor in UiPath or if you're planning to become an investor in UiPath, and have a wonderful day.